The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
And our stock of the day is Zip, the company flagging exceptional holiday trading period in the last quarter with revenue up just over 20% to around $270 million. Revenue margin slipping 7.9% from 8.2%. The stock, which is up 250% since this time last year, losing ground significantly today, off by about 20% in fact. Now in the meantime, it said net bad debt represented around 1.5% of total transaction volume, has a total group cash of $35.3 million, up more than 50% from the second quarter. And Chief Executive Cynthia Scott highlighting the strong growth of Zip's US business, saying our strong performance was driven by outstanding US growth, with year-on-year total transaction volumes and revenue growth of 38.3% and 41% respectively, driven by an exceptional holiday trading period, which included the single largest trading day and month in Zip's history. Market, though, unimpressed. Nathan, what were your thoughts?
Yeah, look, Zip's probably one of the better ones in the buy now, pay later, because from the start they had a lot more standards in checking things. So in that context, it was my preferred one in that space, but it's a high risk to play in a slowing economy. It's had a huge run, which is natural when we are in an environment where the US government is, historical high debt. It's pretty much every country around the world is running higher debt to GDP than they've run in the last decade, if not ever. So in that scenario, there's a fair amount of debt in the market. Guess what? Consumers are doing the same thing. Credit card defaults in the US have jumped up quite a bit. In the smaller end, it's actually nearly a decade high. So in that context, it's not a surprise that bad debts are going to rise. I think Zip's run way too hard. You're pricing in way too much. And US economy, if you look at it on an aggregate terms, probably the top 20, 30% is doing pretty well. The middle 30% is struggling. The bottom 40% is really struggling. They're technically in recession, just like in Australia. The bottom half is in recession. So I'm not surprised the numbers are going to struggle. Expectations are way too high. So I'm not surprised. I'm not chasing this one. I think it's classic cyclical. And as consumer spending slows down, so will buy now, pay later stocks. So
yeah,
I'd be taking my money and going somewhere else.
All right, a sell from you then. Maybe you should have said that yesterday, given it's down 20% today.
Well, the thing is, you've done so well through the last, optimism cycle over the last year, that even if you went through the cycle, you're still way ahead. So take your money and go somewhere else.
Yeah, it is relative. You're right. Mark, how are you seeing it?
Well, if you listen to Henry Jennings and his Advent pick, the 20%'s nothing.
That was from over 12 months ago, though.
No, I know, but you've absolutely killed it. Yep. So, and I don't think you want to give that profit back. I agree. It's a sell. The best call I've ever made in this stock basically was stopping people buying it when it went on that dramatic fall from around $6 to $8 down to 20 cents, and because there was a lot of people who went, it traded up here at $15 or whatever, surely it's a buy here, and they were wrong.
Well, that was back in the day when BNPL was all the rave, wasn't it?
Well, and I think Afterpay had just basically been taken over as well, and they sort of played it fairly perfectly. But I think that, more to Nathan and I's point about the economy ticking along okay and no real need for the rate cuts is record holiday periods like in trade, consumer trade. So I think what's happening, the bad debts I would expect would start to go up. I think they're starting to get more and more traffic on the basis that US credit card debt is well through record highs, and people are probably maxed out on their cards now, and their average balances are now, all that COVID savings completely gone, and the average balances on US credit cards now is well into the negative. So they're probably starting to tap these pay in full style, payment plans. So it could very well be that people have just maxed out their credit card, and this is the next best option. And it's pretty good from a budgeting point of view. But look, it's been a good run. I don't think, the 20% is just taking some heat out of it. It was always, to hold prices today, it was always going to have to sort of shoot the lights out. So any blotch at all really was going to be a probably a sell on this. So if you've been holding it, yeah, I'd be taking some profits, at least trimming half, if not selling the whole lot, and because it is a cyclical, and those bad debts will start to wind up. I mean, the difference between these guys and Afterpay, to Nathan's point, is that these guys, there is a credit check involved, whereas Afterpay is, you know, it's not a credit instrument. You know, they will take bigger hits with the way their product's set up. But yeah, I would say this would be the canary in the mine shaft for people defaulting on things, and you know, those bad debts will start to go up. So yeah, I'd say it's a sell for now, and you know, maybe have a look at it a little bit lower potentially, but it's not really. Like I said, we've steered clear for quite some time, and we're not really into that sort of bottom picking at 20 and 40 cents. Although it represented value down there, but yeah, it's not really for us generally anyway. So yeah, I'll say it's a sell.
There you go. That is a double sell then for our stock of the day, Zip.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.